Course by Deep Charts. My name is Andrea, and I will take you with this course from zero to understanding everything you need to know about order flow, understanding how to read the auction, understand how all of the market mechanics work, and most of the trading tools. So I'm very excited to have you here. Welcome. So what you learn in this course is, first, what is order flow and why you should even use it in the first place. Understanding futures contracts, everything you need to know about futures contracts. How the double auction works. The types of order flows and data feeds. The main matching algorithms that exist. The time and sales tools and how to read it. Then we're going to get a look to the depth of market. And let's say these are the two main order flow tools. You know, they are the basic. They are the raw version, the rawest version of order flow. This is the old school stuff that a lot of people in the pits used to only look at these two tools, the time and sales and the depth of market, and trade just out of those without even looking at price charts. So it's going to be very awesome. And then we're going to have reading deep print, so everything that relates to order flow candles and what is commonly known as footprint charts, and reading the volume profile. So we get deep into tools that take order flow and translate it in a visual way, in a way that we can follow the big money. Then we have reading the VWAP, which is, as you all know, a very important institutional reference for fragmenting orders and increasing execution alpha. And we're going to understand how to read it, how to set it up and everything. We're going to read the CVD, which is a cumulative volume delta indicator that basically takes the aggregate of the order flow you see inside of a session and basically displays it in a way that clearly shows you market pressure in a very intuitive way. Then we're going to understand the basics of the liquidity auction theory and the auction market theory model, the types of auctions seen from the footprint chart, some typical footprint patterns, and finally the session flow. How does the auction flows inside of a session? Is there a rhythm that we can follow throughout every single day, and that we can read through order flow? So this is what you're going to learn inside of this course. We're probably going to make these slides available for you anyways, and you're going to be able to download them. You're going to be able to rewatch them. You can rewatch this course how many times you want. I strongly advise you to watch it as many times as you need to truly grasp and understand everything, because we're going to go deep into all of the good stuff. And don't worry if at the beginning, as a beginner, it's going to be a little bit harder to maybe catch up with everything. I can assure you, if I'm going to try my absolute best to make it super duper simple, and to, you know, remind you to rewatch it at least a couple times. Okay, at least a couple times. It's really needed to properly understand everything. So maybe take pen and paper if you feel like, or download the slides and then, I don't know, scratch on them and, you know, sketch some drawings on top of it or whatever, and enjoy the course. Hi, and welcome to lesson number 1 of the Order Flow Mastery course by Deep Charts. In this first lesson, we'll first understand what is order flow and why you should use it in the first place. So, price candlesticks are a phenomenal tool, okay? Just reading candlestick is already a pretty powerful way to analyze markets if you do it in the right way. Still, just using candlesticks, I personally, objectively, think it's just like using a good old bow and arrow, right? Does it work? Yes. Does it still, you know, can you still hit the target? Yes. But it's a primitive tool. It was born in the 1950s. Sorry, in the 1850s. So it has a great legacy, but it's also somewhat obsolete, even though it is still very actual. When you hop onto order flow, you're using a ballistic bow, for example. It's the same thing. You can be more powerful. You can be more precise. You can have more tools at your disposal to allow you to make you more precise, hit further targets, hit targets with a much higher accuracy. That's what order flow is. That's why we put candles on steroids, how I like to say. Because we want to improve the tools we have in the first place to give us a better informational edge and advantage on most traders. So can you hit the target with both of these tools? Yes. Absolutely yes. But which one increases your edge? Of course, the second one. So that's the one you should master to begin with. That's why we want to study order flow. That's why we want to use order flow charts to get an informational advantage. If we are a detective and we do not take into consideration all of the evidence, we could arrive to the wrong conclusions. So you cannot allow yourself as a detective of market to not detect crucial information. That's what order flow is. And that's why that's the language you should master. Because we're trying to understand the language of markets, right? And price is the result of that language. It's the verbs, it's the words, it's the verbal part of the language of the markets. But order flow is the root. Order flow is the emotions of the language. Order flow is the details and the body language. Order flow is the deeper layer of understanding the language of the markets. And if you are going to be able to master order flow, you're going to reach a deeper level of narrative that simply cannot be understood just by looking at price. You can assume it through price. You can guess it through price, sometimes in an accurate way, sometimes not really. So, master order flow. Let's make a few examples of the types of order flow tools that exist and that you, as a member of DeepChart, will be able to use. First one is the footprint chart, and as we call it, the dip print, because it has a vast array of types of visualizations and order flow dynamic visualizations that make it deeper than most footprint charts you see. And it basically showcases aggressive buyers on this side, in the green side of the candle, in the right hand side of the candle, and aggressive sellers on this other side, which is the purple part. And all of these aggressive sellers and aggressive buyers have an interaction with passive buyers and passive seller respectively. So aggressive buyers buys from passive sellers, and you see them here, okay? So here, 88 contracts were bought and sold, okay, at the same time, because if there's a buyer, there needs to be a seller. So this one is buyers who accepted paying higher prices. These ones are sellers who accepted paying lower prices. And we'll go right deep into what this exactly means very shortly. But I invite you just to look at this, for example, right? This was a candle that went down at first. So we had the open here, and the candle went down, and it found a so-called iceberg order, a wall of orders that no price action trader can even imagine is there. And right after that, you had a huge run to the buy side. These things you cannot see with price action alone. That's why we use footprint charts. because we can see things that are simply not seeable through price. You have a huge seller here trying to push down, but there's a huge buyers blocking that inertia and then pumping right price up with a momentum ignition and shooting market orders in the market and filling the order book and eating it out completely. So this is one of the tools. Another tools is, all of the wide range of volumetric charts. And you get the volume profile or volume by price, which basically tells you how much volume was traded at every single level of price, either of this session with the session volume profile or cumulatively in all of the charts that you see, which is the cumulative volume profile. And it's called volume by price because it tells you the total volume of trading activity, buying and selling activity at each level of price. So it indirectly tells you how much money was traded here, how much money changed hands inside of this price range at this specific time. So this is a very powerful and crucial indicator to follow the big money in the markets, because you just know that wherever there's big areas and big trading volume, it's because there's a big trader. If there's thousands and thousands and thousands of contracts all stacked in a single price level, it cannot be a retail. It's probably institutional algorithms getting their fill, right? Or really big traders. So we have them per level of price and also by time. This is volume by time. And volume by time tells us how much participation was there in a price swing. How much activity, how much interest and participation was there in a determined price movement. That's volume by time. And it comes also in a vast array of ways and different visualizations and fashions. Then you have the liquidity heat map, which is another amazing tool that you may know as Deep DOM or Deep Map, that basically showcases passive sellers, so all of the sell liquidity resting in the order book, waiting for an aggressor to come and pick it up. So the market maker liquidity. Okay, this is called the market maker liquidity. We have passive sellers and passive buyers, and we can have a heat map that shows us the historical depth of market, which is, this liquidity, these passive buyers and sellers, also in the past. So it tells us with a heat map which are the areas with the highest level of institutional liquidity, of market making liquidity. There's huge areas with ridiculous amounts of market making liquidity, hundreds, thousands of contracts, layers and stacked all in a single price range that price simply cannot go through that easily, and that acts as support and resistance. Same here, a big level of liquidity that as soon as it gets deleted, it's completely ran through. This is other crucial information to take informed trading decisions. Then you have all of the world of volume-based indicators, which are absolutely phenomenal tools like the VWAP that we mentioned, like the CVD, the volume-weighted average price, which is not just an EMA or that type of chart. It is an institutional reference which is widely used as a best execution algorithm and reference. And then you have CVD, which is the cumulative volume delta, which again is a measure of who's more aggressive, who's more passive, okay? So what is behind these tools? Well, a flow of orders, buy and sell orders, aka supply and demand. An order flow chart are a summary of the decisions of market participants. It shows you how and why price did or will do something. And it gives you a clear picture of who's dominating the market auction at a specific time, with a level of clarity and accuracy that price action alone simply cannot provide. It's pure and raw trading data that most retail traders are actively choosing to stay blind to because it's too complicated, and now that's your advantage. Now let's go quickly through some best use cases for order flow. Where is best to use it? Well, for day trading, absolutely yes. For scalping, that's where you can give your best with order flow. For swing trading, not necessarily order flow per se, so footprint charts and short-term order flow liquidity dynamics. But for swing trading, if you are a swing trader, if you want to be and become a swing trader, volume profiles are an absolutely crucial and phenomenal tool to assess which one are the areas with the highest likelihood of having a responsive type of auction that will move price up or down. So if you're a swing trader and you're not using volume profiles, you're missing on a bunch of cool stuff. Now, the best time frames to use order flow are typically, I'm talking about footprint charts and short-term order flow dynamics, of course, the 15-second charts up to the 1 minute, the 3 minute, the 5 minute chart. The more you go up, the more noise you're going to see, and the less you're going to be able to take advantage of short-term order flow dynamics, and the more you're going to have to realize that the tool that can help you is actually volume profile. But for short-term time frames, that's when order flow gives its absolute best. Now, the types of asset in which you can read order flow are basically anything that has some centralized exchange, right? So you have futures contracts based on equity indices like the S&P 500 and the NASDAQ, but also commodities like gold or US oil, or equity indices like FDAX. Then the equity in the stock market, so single stocks, they also provide volume. And the cryptocurrency market, even though as it's traded over the counter in many different exchanges, you have to at least aggregate the volume and the trading activity data from a variety of different exchanges like, Coinbase and Bybit and Binance. You need to put them all together and have them in a single chart, which is something that is going to be delivered in our technologies very soon. And anything that has some level of centralized exchange or that can be aggregated in a way that makes sense is a potential order flow tradable asset class. Now, the types of strategies. You can literally build any type of strategy with order flow, because remember, order flow is a tool, is not a strategy. It is a tool that helps you have a clearer vision and a clearer understanding of current market sentiment and mechanics and pressure and initiative and responsiveness. It's not a strategy in and of itself. It's a tool to build strategies and narratives. And you can use it for breakouts and retests, min reversions, momentum trading, intraday swings, literally anything that is intraday scalping. Order flow can help you. Now, so get ready, and I will see you. So get ready, whatever type of strategies you use, even if it's a price action strategy, if it's an intraday or scalping strategy, you're going to find help inside of this course, of this program, of the software. Just take time to learn the language, and you will discover a next level of informational advantage that will help support and facilitate your trading decisions. Hi, and welcome back to the Auction Market Theory 102. We're going to discuss now trading ranges in failed auctions. So whenever price approaches the extremes of our fair valuation area, where statistically 70%, which is a standard deviation, of volume is traded, of money is exchanged, of trading activity is happening, we get into the anomalies. Okay? The same principle we've decided and decoded before. These are the areas where we either want to sell at as soon as price approaches them, when we see confirmation from order flow, or wait to be broken and see an attempt of an upside auction failing, which is even better. Okay. Same thing over here. When this happens, or when this happens, those are potential high probability buying opportunities. So we want to then take a look at what happens with order flow inside of these areas to find a confirmation that passive and aggressive forces are giving us a asymmetric opportunity from a risk to reward and win rate standpoint. So we want a high probability of going up and a high risk to reward for taking that trade. So these are very simple models, very simple models. We take a daily volume profile and we look at what happens here, what happens here. We wait for a confirmation that price will drop back inside, and we take that trade to the other side, and vice versa. Now let's make an example, a practical example, by looking at a situation of clear fair value and looking at what happens in the following session. Well, we know these are the areas, so let's remove the volume profile so we can just see the price action and the order flow. The next session starts here. So we already have a good indication. We started our session inside of the previous value area. Then what happens? Take a look at order flow and we read what might have happened. Well, the first idea, as we said, is we're going to try and see if there's any buy opportunity here, right? So we see price dropping, dropping, dropping. And at some point here, we see a lot of volume traded from both sides. So we have a war here between buyers and sellers, which we could consider some form of absorption. And when we try to auction lower, what happens? There's a dry up in volume. There's some selling, but buyers are way more aggressive. Well, that's a failed auction right here. We have a big phase of absorption. So we probably price did something like this, tried to push out, then was dropped back inside by aggressive buyers. So we have a failed auction. And then price pushing high really aggressively. A lot of imbalances on the side. That's when we know where we have, let's say, the first indication that price is likely to bounce back off. Can take volume itself. So there was a lot of volume in this candle, but no follow through. And the following candle dropped back inside. And from here, this is our buy idea to the other side of the range. You could either wait for a test or wait for the following candle to close and even maybe take a slightly lower risk to reward. 1 to 2. And that's a high probability trade. Now let's go to the other side and see what happens. Well, we have buyers really aggressive on the upside. As soon as we're outside, big volume dropping back inside. But the candle still does not close back inside. More aggressive buying is being absorbed here. And as we stay outside of here, volume dries up. So there's a phase of exhaustion. There's not a lot of trading activity here. And then what happens? Well, we drop aggressively back inside with even more volume and a lot of aggression, a lot of imbalances. Well, that's the first indication that we might continue lower. So we either wait for a test here, or for example do this and sell. In this one we likely get stopped out. But we took a good decision. We took a smart decision. The point here is not, making money all the time. The point here is looking at what's happening in the auction and acting accordingly. And then once again, what happens? We tried to drop back inside. We saw there was a lot of aggressive selling going on, but maybe they were not ready yet. So buyers take the upper hand again while being inside of the range. They push price outside, and as they do, volume again dries up. Aggressive selling, pump in volume. And the last candle that tells us buyers are not ready is here, where we see again an exhaustion in buyers that tries to push up very quickly. They go down, and the following candle is just unrefutable proof that we're ready to drop back inside. Look at this. Super high delta imbalances, super high volume, drops back inside, tests, and that's our entry. And slowly but surely, that's what happens. So with this very simple framework, we took one trade, take profit. We took another trade, stop loss, and took the last trade, take profit. With a very easy framework, looking at what buyers are doing, look at what sellers are doing, framing the auction correctly, so we have a context of what we want to do. And we take the decision based on data. We take the decision based on what the money is telling us. Hi and welcome back to the course. This is Futures 101, Understanding Futures Contract. So we're going to get deep into futures contracts and how they work. Let's first clarify what are derivative contracts in financial markets. You have a distinction that you need to make because a lot of people say, I trade Forex. Yes, but that's an asset class, okay? I trade futures. Well, that's a contract. Do you trade futures or Forex? Well, I could trade Forex futures. So we need to properly differentiate what is Forex, what is futures, what's a contract compared to an asset class, a market, an underlying asset. So underlying assets or markets, asset classes and market types are, for example, currencies, the Forex market, or commodities, or bonds, the bond market, stock market, the cryptocurrency market. These are underlying assets, assets that lie under. So they are the base. Derivative contracts instead is what we actually trade. We don't trade by buying and selling physical gold or physical oil, or by actually going to a foreign exchange desk and changing our money, literally, right? We normally trade contracts. Of course, if you're speculators, you also can buy underlying assets like stocks and bonds and cryptos, but likely if you're a short-term speculator, not an investor necessarily, you're going to use derivative contracts. And you have many of them. You have CFDs, options, futures, swaps, and others. And let's make an example just to make you understand. For example, if the underlying asset is the exchange rate between euro and dollar, which is euro USD, a CFD, a contract for difference, might be euro USD. A futures contract might be 6E. If it's gold, you're going to have the CFD, which is typically XAU USD, and the futures, which is GC. It's a different type of contract. So for example, here, yes, it's Forex, but it's Forex CFD and Forex futures. This is gold, gold CFD, and gold futures. The S&P 500, for example, the US 500 for CFDs, and the ES for the E-mini future contract. Some facts about future contracts that you need to know is a future contract technically gives the right to the buyer to buy the underlying asset at a future date or expiration. So yes, they expire. Some expire every month, every 3 months, every 6 months, depending on the contract. But they have an expiration where you either buy the underlying asset or sell, for example, or you roll over the contract. You roll the contract over. So you basically roll it to the next expiration. And they were born for hedging purposes in commodities. That's why we have the Commodities Future Trading Commission, which is the CFTC, which also releases the COT report, the very famous COT report, which, by the way, is based off trading activity of futures contracts, okay? And as I said, futures contracts were born for hedging purposes in commodities a long time ago, okay? Like imagine IKEA, right? Imagine you're IKEA and you build furniture. Well, you're gonna need a lot of wood, right? So if you expect the prices of wood to rise in the future, instead of waiting until the price rises, you can buy a future now, a wood futures, that gives you the right to buy the underlying asset at a future date. So you buy it now, maybe at 100. In the next few months, the wood may rise in price, but you still buy it at 100. Similarly to what happens to an option in some way, even though it's completely different. But this is the idea, right? You hedge the risk of commodity price rising by buying a future. That's what the original and most vast use of futures contracts was. And then with the upcoming financial futures market, they became also a speculative asset class, a speculative type of contract, not just for hedging purposes. Now, some features of futures, or futures features, sorry for the wordplay, they are centralized and regulated. So unlike CFDs that are traded OTC, are a very untransparent, low grade, low quality, low transparency type of asset class and type of derivative contract that are not traded all at the same place, all in one exchange, but are traded in a variety of different brokers and banks and liquidity providers that are very, very difficult to put all together to kind of come up with some trading activity and reliable volume data. Futures are centralized and they are regulated in the way they transact, unlike CFDs. They may require higher margins than CFDs, depending on the brokers. Some brokers are like really, really good with margins. You don't need a lot of money to trade futures. You can open an account with, I think, as low as $100 or $500 maybe to trade micro contracts. So it's completely doable for, people who cannot afford, to have $50,000 of their account. It depends on the broker, but margins are doable, let's say. And to trade them, you only need to pay commissions, though. There's zero spread markup from brokers. A lot of you people coming from the Forex space might know that CFD brokers apply a extra spread on top of the market spread because they want to earn more money from your trading activity. Maybe you've been through a signal room and you didn't realize that your guru, your favorite guru with an offshore broker, put a 3 pips spread on euro dollar that normally should be 0, right? That shit does not happen in futures market because they're regulated, because they're centralized, because they're professional contracts, they're professional trading tools. The biggest futures exchanges include the CME, the Chicago Mercantile Exchange, the COMEX, the Eurex, the NYMEX, the ICE, and a lot of other exchanges around the world. And since they are traded in a single exchange, we can pay the exchange a monthly fee to access all of the exchange order flow and trading activity through a so-called data feed. So basically, we can download the trading data, the trading activity data from the exchange itself through something called a real-time data feed, which is order flow. And another feature of futures is that there's no fractional lots, okay? So there's no contracts like CFDs, mini lots and micro lots, 0.01, 0.10. So you cannot fraction a contract. But you have micro contracts. So you have mini contracts, which is basically your 1 lot, and micro contracts, which are basically your 0.10, but they still count as 1. So you cannot fraction contracts. Welcome back to the Futures Introduction course. This is Future 102, ticker symbols. Futures contracts have names, also known as tickers or symbols, that are structured in a way like this. This is the ESM26. Let's understand what that means exactly. So the ES is typically the first 2 letters are, or maybe 3 letters, are the contract name. So it's the E-mini S&P 500, which stands for the underlying asset, S&P 500 E-mini contract. This is the table that you can screenshot if you want of the most popular contracts. You can find it anyways inside of the Deep Charts platform. As soon as you select an instrument, they're all divided by, exchange and the symbol and the description. So typically you're going to find the ES, the NASDAQ, and the micro version in the CME together with all of the Forex. And on the CBOT, you're going to find bonds, commodities, the Dow Jones, for example. And in the COMEX, you find a lot of commodities, and especially actually metals. So you're going to find gold, micro gold, copper, silver futures. And in the Eurex, you're going to find Euro stocks, FDAX. And in the NYMEX, you're going to find crude oil, natural gas, and a bunch of other ones that you can find here all the time. You can just simply type to filter, and you're going to find them. Now, the middle letter, it's a symbol that normally stands for, it's normally a letter, sometimes it's just directly the number, but just for your information, it's the expiration month symbol. So the ESM26 is the ES contract expiring on the month of June 2026. This is the table of the month symbols if you want to screenshot it. So we have F January, G February, H March, J April, K May, M June, and so on and so forth. And in our platform though, you just have it like this. So ES 2025 12. So you know it's December already. So you don't need to come up with a bunch of letters, and you don't need to memorize them. So of course, we'll try and make it easy as possible for you. And the last one, of course, is the expiration year. Hi, and welcome back to the Futures Trading course, Futures 103. We're going to talk about tick size and tick volume, tick value. So the tick size is basically how big is a tick, number-wise. So if we look at a price ladder, right, at price, you get lower prices and higher prices, right? A tick is the smallest step possible in the price ladder. So the minimum variation of price of the futures ES contract is, in this case, 0.25 points. So you can see 25, 50, 25, sorry, 75, 0, 0. Then again, 25, 50, 75, and so on and so forth, both up and down. And 1 point is 4 ticks. So if you go from 95 to 96.00, you're gonna go up 1, 2, 3, 4 ticks, okay? And tick value instead is, if I, for example, buy or sell one ES contract, how much money will I see floating up and down in my P&L? So for example, if I buy one ES contract, that will create a change up or down of $12.5 per tick, or $50 a point. So for example, I bought here at 68.95.50. My P&L is 0. As soon as I go up 1 tick is 12.50, up 1 tick 25, up 1 tick 37, 50, 62, and so on and so forth. And if, of course, price goes down because I bought, I'm going to lose 12.5, 25, 37, 50, and so on and so forth. For micro contracts instead, a micro contract like the MES will typically be 1/10 or 1/5 of the tick value of the, let's say, mini contract. So the micro contract will be $1.25 dollars per tick, or $5 per point, right? $50 a point, $5 a point, 1/10. Because you see, from 95.50 to 96.50, that's $50. And that is tick value. Hi, and welcome back to Deep Charts in this futures trading course. And this is Futures 104. You're going to learn the types of trading orders and OCOs and hedging inside of futures. This is a very important lesson, crucial lesson if you've just traded CFDs before, because it's going to teach you how trading with futures actually works and how it is different with all of the market orders, stops orders, blah, 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 blah. So please be really mindful about this lesson, especially if you have never traded futures before. So let's bring onto our screen our deep charts, and we're going to have a normal chart here, and on this other side of the screen we're going to get the order book. I'm going to maybe put them like this a little bit. Yeah, awesome. So how does the trading actually works, right? So basically, I have this trading terminal over here that has 5 types of orders, okay? The buy limit is very easy. I'm gonna place a buy limit, for example, below the current level of price and wait for that order to get filled. And as you can see, I have it here. I can see it here, right? I cannot put the limit order up, right? Because if I put it, it's gonna open it market. Look at this. If I'm gonna release it now, 3, 2, 1, there you go. It's opened market. So you might really want to be careful about this, right? If you place a limit, it has to be below price. And we're going to be exactly like any buy limit. We're going to wait for price to reach a little bit down and then fill the order. Nope, it's not filling it. Okay. We can do the same with by placing it here. So we're going to just wait and boom, we're filled. So you put it below price, and then you can simply drag the stop loss and the take profit like you would do normally. But as you can see, this is a -1 limit. This is a -1 stop. So take profits for buy positions are limit orders, are sell limit orders. And if you go inside here, you will see you have a sell limit right over here and a sell stop right over here, because limits are typically for sells above price and sell stops are below price, right? So as soon as this is closed, there you go. My position is 0. So I basically bought here, sold here. But as you can see, there's still my stop loss over there that I have to manually get rid of. And that can be kind of annoying sometimes. And that's why OCO strategies come into place. So for example, if I place an OCO strategy with a stop loss, let's say, of 50 ticks, and I buy market, it's going to automatically, do you see this little symbol here? So if I, for example, place a take profit here, or I close my trade, the stop loss will be automatically canceled. OCO stands for one cancels other. So instead of going and, for example, buying market without an OCO strategy, so I'm going to just buy and then put a sell stop here to close and put a sell limit here to close, and as soon as it's closed, this one is going to be stay on the chart. With an OCO strategy, I can make sure that that doesn't happen. Okay? And this is even easier on deep charts because you can simply, place your projection and then simply enter order, and it will automatically create a OCO strategy for you. This is something really normal for futures contracts, but we try to make it simple like this also for former CFDs or Forex traders. And by clicking cancel, you can simply cancel every order that you put in the book. And again, that's buying market. Buying limit would be placing a buy limit here, or selling limit would be placing a sell limit above current price. But let's say, for example, I want to trade only when this wick was broken. What I can do is place a sell stop slightly below that, and this sell will be activated if and only if price reaches below that. Okay, and it doesn't. So awesome. Same thing if, for example, let's say I want to buy, I can buy stop only if I see this candle broken up. And there you go. I get filled and price broke out and we're profiting, so that's awesome, right? Okay, and that's how buy stops and sell stops work. So as you can also see, if I, for example, buy again now, and then let's say price goes up from here, hopefully it goes, yep. Let's say now I want to sell because I think price is going to go down. Well, I cannot simply sell, just like I would do on CFDs, and hedge my buy position with a sell position. I cannot do that. I have to because if I click sell and now my net position is +1, that simply means I'm long one contract. If I'm going to sell, I'm not going to open an extra sell position here. I'm just going to close this one, right? Let me sell market, for example. There you go. My position is closed. My position is flat. So if I wanted to, for example, buy first and then maybe sell to hedge my position, I have to go, for example, on the MES, on the micro, and open 10 contracts of these so that I can buy one contract on the ES and hedge myself with the MES. So that's how you hedge in case you ever need it, which I highly doubt that will be a frequent case scenario. But for everything that relates trading and orders and how to place them, stop loss, take profit, OCOs, and hedging, that's all you need to know. Now, I would strongly advise you to open your Deep Charts platform and placing orders in a demo account with a 50-minute delayed data feed just to test, because we're going to provide you a sim account anyways. Test how to place orders if you haven't yet, and really get to understand how they work, how they're canceled, what happens if you don't connect them, try to just cancel or just to flat the entire position, blah, 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 blah. So give it a quick test, and I will see you in the next video. Hi, and welcome back to the Order Flow Mastery course. We're going to now start the Market Micro Mechanics 101 course. And the first lesson is understanding the auction. So in the academic world, there's been a lot of studying on the models of auctions and how they work. Several Nobel Prizes in 2020 were awarded because of the elaborated theory of the auction. And you typically have three types of auction. You have a forward auction, which is the classical one, where you have a seller and a lot of buyers trying to, get their hands on whatever they're selling. You have a reverse auction and a double auction. The auction of liquidity in the markets, which is the underlying mechanism that moves every single market in the world, is a mix of a forward auction and a double auction, okay? Where you have both buyers and sellers interacting with each other. So a classic forward auction is something you might have seen in the movies, or maybe you have attended one, where there's a bunch of paintings being sold at the auction. There's a middleman, a auctioneer, with his little hammer, and all of the rich buyers that are called the bidders, because they make a bid, right? They offer a higher price than everyone else. So the participants of an auction, if we have to categorize them, are the auctioneer, the paintings themselves, so the sellers, the goods being sold at the auction, and the bidders. And in this case, the bidders would be the demand, the paintings would be the supply, and the auctioneer is the middleman, right? And in an auction, you would have, again, the bidders, the auctioneer, and the painting sold. And let's say the first price is 1,000. Well, someone comes and says, I'll pay 1,100,000. So original price is 1 million. He's going to pay 100K more. Well, awesome. That's the new price. Who can offer more? Another guy comes, says, I'll pay 1,200,000. Well, awesome. That's yours, unless someone else is willing to pay a higher price. So the price of the good is determined by this mechanism of, is there anyone willing to pay more? This is an auction, right? And the liquidity auction works exactly the same way, with the exact same type of participants. So you have the bidders, the demand, the auctioneer, the middleman, and the paintings that are the supply. And the supply is not of paintings, but it's a supply of buy and sell orders. That's why it's a double auction, because there's not just things being sold. There's things being sold and things to be bought. Both offered just like the paintings in the auction. They will not move price by themselves, because they're just the paintings, okay? Someone else would decide if that price is good and if they're ready to pay a higher one. Then that one would be the bidders. So the one who actually moves price up and down, which is the demand of buy and sell orders, the demand for paintings. And the middleman, the auctioneer, will be the exchange in this case. So the exchange facilitates the auction by putting in contact the demand for liquidity, the demand for buy and sell orders, and the supply of buy and sell orders. Okay? We'll call the supply of buy and sell orders passive liquidity, which is displayed in the so-called central limit order book, and the demand for buy and sell orders aggressive liquidity, which are simply market buyers and sellers. So people who, just like we did before, are clicking the buy market button. Well, these are the limit orders, the limit buttons. And of course, in the middle, in the exchange, everything is facilitated through so-called matching algorithms that we will get to know shortly. Hi, and welcome back to Micromechanics 102. we're going to learn the double liquidity auction. So, as we've discussed, these are the paintings being sold at the auction, right? And we call these market makers because they make the market. Also known as passive liquidity or resting orders. These are nothing more than orders of, buy and sell orders displayed in the order book, also known as market depth. And up here you have the sell limits, so passive sellers, also known as the offer or the ask. And these are basically just offering to be a seller. Okay, they're saying, hey, if you want, I'm selling at this price. They are the auction of sell orders, the sell paintings of the auction. And they wait for someone to accept their sell offers. Just like when you place a sell limit, you wait for someone, wait for the market to reach your level and fill you, right? Below here, same thing, you have buy limits, passive buyers, also known as the bids. And they're offering to be a buyer, okay? They are the auction of buy paintings. And they wait for someone to accept their buy offer, okay? So they're just waiting. And we call the closest bid and the closest ask to the current price the best bid and the best ask. So the best ask is the best possible price at which there's at least a seller available in the book. The best bid is the best possible price where there's at least a buyer in the book. And again, these are just resting orders, okay? There's offers of liquidity, just like paintings sold at an auction. Someone now needs to raise their hand in the audience and take action and accept paying a slightly worse price for the trade to happen. If you want to get your hands on the Mona Lisa, you're going to pay a little more if you want it, because other people are ready to pay. So the bidder comes and say, hey, I will buy 2 contracts, market. And he will get filled by being a market taker, okay, as we define it, a aggressive buyer. So he says, I will buy 2 contracts, market. So those 2 contracts that were present here will go all the way here and get matched with his 2 buy contracts. So 2 buy, 2 sell, they're matched. It's a match. And who did the matching is the matching algorithms, the CME, the exchange. Now this is the new price, right? Because as soon as someone raises their hands in the audience, that becomes the new price that someone needs to beat, right? Exactly the same. Now this is the new price. The new price is set as soon as there's a match between a aggressive participant and a passive one. And with normal candles, this is where your candle would open, right? Now another one comes, says, I will buy 2 contracts at the best possible price. Well, those 2 contracts are matched with 2 contracts from those 5 that were here at 101. That's a match, and boom, price ticks up. And that's because the new price is wherever there was at least one match between an aggressor and a resting order. Now a seller finally comes and says, hey, I will sell 5 contracts at the best buyer. Well, who's the best buyer here? This guy. 2 contracts at 99. Well, he wants 5. Who's the next best buyer? Here. Okay, so I'm going to buy some here and some here. Yep. That is called slippage. Right? Probably heard about it. So you get, this order got slipped and some of it got filled here and some of it got filled here. So the average price of this trade will actually be somewhere around the middle, because I paid 99, I paid 98, so probably the average is like 98.5 or something, right? But the last place, the last price level where there was a match was this one, right? So that becomes the new price, and the candle will tick down. Okay? This is the mechanics behind every single price movement that you see inside of charts. That's it. Okay? Now, the best ask and the best bid are far away from each other, right? They were here close and now they're far. We call the difference between bid and ask the spread. And in low liquidity environments, so where there's no liquidity, no counterpart, no sell or buy orders counterparting the aggressors, spread widens. So, markets, to recap, just like in an auction, move because someone is willing to pay a slightly higher price that we call spread. So if you're ready to pay a spread and buy market or sell market, you're going to move price, even with just one contract. So prices in financial markets move because someone is willing to pay a slightly higher or lower price to buy or sell, as long as they can get their hands on a counterpart. Because think about it. You could, if you wanted to buy, you have two options. You either place a buy offer, so you just offer to buy, and place a buy limit at a slightly better price, and hope that an aggressive seller would accept that offer. Or you immediately pay a higher price to guarantee you're going to get filled now. But you're going to have to accept a slightly worse price. Do you understand the difference? So markets are moved by traders who cannot afford to wait to get filled. Kind of in a FOMO, right? I cannot wait to get filled. I want to be in the market now. These type of participants are the one who move the market, who causes a change in price. Now, let's imagine, for example, that Apple has just discovered a new technology that will 10x their profits because they're going to make their iPhones finally make coffee as well. What will happen to their stock price? Well, let's pretend this is the order book of Apple stocks. Well, first of all, you're going to see less passive sellers, right? Because no one is really willing to sell so much now. So that also means that compared to here, it's going to be way faster for price to go up. Because if 10 aggressors come now, the price will be 102. If 10 aggressors come now, price will likely be way up. So the amount of liquidity that's here will determine how fast price goes up. And if there is a huge imbalance between the bids and the asks, it's likely that this, direction is the path of least resistance. So now everyone buys, okay, and price shoots up. And as we know, it's a very well documented phenomenon happens, which is price pokes through the ceiling of traders. So this does not happen because there's more buyers than sellers. As a lot of people say, the market is long, the market is buying. No. There's always a buyer and a seller. They're just matched at a different price, and whoever was the one accepting the worst price is the one moving it. So this does not happen because there's more buyers than sellers, but because buyers were willing to pay worse and worse prices as long as they could get their hands on a seller, which is a slight but very important, crucial difference. Hi, and welcome back to the Market Mechanics course. This is Market Mechanics 103. And how do we summarize what we've learned? All of this auction activity in a chart that shows it. So we said that these two contracts are matched, right? There's a buyers that's matched with a seller. It's a match. That's the new price. The candle opens. Now, let's add one more layer. Let's have a little table that summarizes for us aggressive buyers on the right-hand side and aggressive sellers on the left-hand side. So that buyer that bought, we place it here. So 2 contracts here mean an aggressive buyer was ready to accept to pay a slightly worse price to get filled. This doesn't mean there were 2 contracts bought or there were 2 buyers. Yes, but there were also 2 sellers. Always remember that. And 0 here, because no contract was sold aggressively here. Another one comes, takes 2 contracts at 101. It's a match. Price moves up, and we put those 2 contracts here. Big 5 contract order placed by an aggressive seller eats those 2 contracts at 99, those 3 contracts at 98. So we place that 5 contract, now that this is the new price, 2 that were filled here and 3 that will fill here, and 0 here, of course. So this is what we call a footprint chart or a bid-ask footprint chart. It basically summarizes for us what happened during the auction, what caused price to move, what are the orders that pushed market in a specific direction, how many were they, both from the aggressive side and the passive side, because if there were three contracts sold, they were aggressively selling and passively buying at the same time. So the bid-ask footprint basically tells us with a little bit more detail who was the aggressive and who was the passive. And if you want to summarize them, you get the volume profile. Okay, the volume profile is simply how much volume per price. So the volume of transactions. So here there was 2 transactions, 2, 3, or even better, 2 orders transacted, 2 orders transacted, 2 contracts, even better. 2 contracts, 3 contracts. So we put them here, just with a histogram, right? So if this is a sell candle, now let's say, we just bounced right off of a resistance or a supply zone, however you want to call it. So price went up, up, up. Sell candle. Well, a price action trader would wait for this to sell, right? They would wait for a confirmation from price, okay, from price that sellers are present and dominating the market. An order flow trader will see this. And already here, he can see there was first a lot of aggressive sellings. We see a lot of red going on. But look at here. There was a buyer who tried to buy 50 contracts. And there was a seller willing to keep selling to him. This is what we call an absorption. That's why it's crucial to understand that these are not simply buyers. So, there's a buyer's price will go up. No. How is the interaction presenting itself to us? Well, the interaction says there was someone trying to buy, but there was someone as big selling at the same time, and price from here did not go up. It stayed exactly where it was despite all of this buying, all of this aggressive buying. Well, clearly, passive sellers are in control here. So it's not a surprise that right after that we see imbalance. We see 0, 0, 3, 1. So a lot of numbers here, low numbers here. That's an imbalance. So already from here, we know that sellers are dominating. While a price action trader would have to wait for here to understand it, to even come close to the precision that order flow can give you. Is that clear? I hope that's all clear, and I will see you in the next video.